For today's discussion, we will dive deep, highlighting a declining market. This is the buyer's market, phase one. The first graph shows the 4 market cycles: recovering, expanding, hypersupply, and declining market. Next is a donut or wheel shape that looks at the 4 markets as well. I like this one because it looks at the gradations in the market cycle. Are we at the beginning of the cycle, or in the middle? Are we at the end of the cycle? This is from a website called IRR.com under Viewpoint. It's worthwhile. It's definitely worth a look. This graph is from Dave Lindahl. What I like about this graph is it focuses on who has the power. Is it a buyer's market? Is it a seller's market? We will look at what triggers and transition points between the buyer's market phase 1 and phase 2 and seller's market phase 1 and phase 2. Now, all 3 of these visuals are used to identify and signify where in the market cycle a certain city or a certain market is located. All 3 of these visuals are used to signify where in the market cycle a certain city is positioned. Why is it important? Well, to gain insights and create a strategy to effectively operate in a current climate. Should we buy? Should we hold? Should we flip? Should we cash flow and wait for appreciation? Should we wholesale or should we sell? For example, let's say we have a property in a particular market yielding a generally expected return. If you take that same property and drop it into a recovering or expanding market, you'll often increase your NOI by 2 or 3 times. If you take that same property and place it into a declining market or an oversupply hypermarket and don't use the right strategy, you can often lose your shirt. So your market selection can dramatically influence your expected returns to your investor. So how do you reduce the risk? Well, first you need to understand where in the market cycle you are to establish a benchmark or baseline to build off of. You need to develop a strategy that will work in your market, then execute on that strategy, and then respond, reposition, re-engage. It really is an active process, but so many investors often overlook this step. Today we are going to focus on a declining market phase. What are the triggers, what are the characteristics and strategies to buy and sell a property in this type of market? Declining market characteristics. Well, this is a buyer's market. The buyer has all the power. The market is currently oversupplied, properties are sitting idle. It's not a good place to be. Jobs are leaving, unemployment is at its highest, demand for properties is falling. Your ability to push rents is declining, so rents in general are falling. Vacancies are increasing. Property prices are dropping. Time on market rises sharply as well. Speculation basically stopped. All new construction is currently overpriced and stagnant. Foreclosures are beginning to rise, something to look at. And then also property values in general are being discounted. Strategy. What strategy should we employ? Now, in a declining market, you are only buying for cash flow. It needs to have strong cash flow because appreciation is out. Even fixing and flipping is out. You're in a downward spiral. Now, the higher the cash flow, the more you can adjust rents and absorb vacancies when they happen before things get really worrisome. Now, property values we talked about, they are plummeting. So you only need and only should buy a deal if it's smoking hot. And only buy a deal if it's got strong cash flow. Do not buy for appreciation at this point. Otherwise, keep your money in your pocket. And don't be fooled. It may look like a good deal because you're coming out of an overpriced hypersupply market. But the problem with a buyer's market phase 1, you don't know where the bottom is. How long will this downward spiraling market continue? Or specifically, how long will rents fall during this time? You will see rents falling and then they may begin to level out. But you will also see a dramatic increase in concessions as well. Keep tabs on your local comp properties as a gauge to see what concessions are hitting the market. That'll be an indicator for you to know what the bottom is starting to look like. Now, during this stage, the dominant characteristics of the market is definitely oversupply of properties now on the market. The market is now overbuilt and both buyers and sellers know it. The market has transitioned from a seller's market to a buyer's market. Now, only invest when you know something is about to happen in the market that will create a positive change in job growth. When a company commits to relocating there, it often takes time for it to fully happen. Also pay attention to new sales velocity and price points and days on market. keep track of it separately in your own file folder. You can read reports and everyone's talking hype, but if you keep track of your own market, you'll get real-time information and you won't be swayed by other people with other agendas trying to hype up a market. Now, when the market changes and starts to rise again, you will be rewarded and recognized as a wise investor when you start buying in the next market cycle. I trust you now see the value of understanding and executing the proper strategy in a declining market. Let me know if you have any thoughts on declining markets. And check out our next video called Millionaire Maker, where we will explore strategies to employ in a recovering market. Make sure to like and subscribe to our channel. We drop new videos every Tuesday and Friday, so ring that bell to be the first to see new content. I'm Phil Russo. Stay tuned and stay informed.